Olex Network 18, Mission Poshan, Bhavishya Roshan.
Asian markets, they started off in the red, but they've recovered from the low point of the day. The Nikkei, the Kospi, both of them had opened up in the red on the back of those weak cues that we got from the United States. This after the United States announced tariffs on steel as well as aluminium imports on several of its allies, and that really was the big news point that came overnight. But just take a look at the intraday chart. Both those two markets have recovered considerably from the lows. You pull up the other couple of markets, as the Taiwanese as well as the Straits. We'll be getting the early rates coming in from both those two markets, so let's see how they have opened up. In fact, a tad bit mixed. The Straits is trading mildly in the red. We had some economic data as well, in fact, coming in from Japan. The final manufacturing PMI for the month of May, that came in the lowest in the last 7 months, came in at around 52.8. That compares with the reading of around 53.8 on a month-on-month basis. But I think the big headline really is that we have recovered from the low point of the day. And let's see what the SGX Nifty is indicating early morning. Well, it's indicating more or less a flattish start, or mildly positive.
And well, the Asian market started lower. That is because United States soused market sentiment by imposing steel and aluminium tariffs on the European Union, Mexico as well as Canada. A 25% tariff on steel imports and a 10% tariff on aluminium will be imposed on imports from these nations. Now remember, the move was announced by US Commerce Secretary Wilbur Ross, and the allies have hit back and plan to slap billions of dollars in tit-for-tat tariffs on US goods. The European Union Commission Chairman Jean-Claude Juncker says that US has left EU with no choice but to proceed with a WTO dispute settlement case and additional duties on US imports. Mexico also responded to this by saying that the measures would be imposed tariffs on apples, pork bellies and flat steel imported from the US. Canada, the second large trade partner of the US behind China, responded with dollar-for-dollar tariffs against US steel and aluminium exports.
So did we just declare a trade war on some of our closest trading partners and allies?
No, not at all. As you know, this has been under discussion for quite a long time, and it's a very small percentage of the respective economy, a fraction of 1%.
It's hard to make the argument that this benefits any one of the NAFTA partners. On one hand, the steel industry is highly integrated in North America. Steel is a very important input to other industries that are strategic throughout North America. And Mexico has been forced, obviously, to take a response and an equivalent action establishing tariffs on a series of products.
Americans remain our partners, our allies, and our friends. This is not about the American people. We have to believe that at some point, common sense will prevail. But we see no sign of that in this action today by the U.S. administration.
Well, let's also get in some commentary from Rob Subaraman of Nomura. He says that trade protectionism is clearly escalating.
It's looking like trade protectionism is clearly escalating. It looks like the NAFTA deal that we thought could go through hasn't. And now these steel aluminium tariffs on EU, Mexico, Canada. And, you know, going ahead later this month, on the 15th of June, the US is meant to provide the list of tariffs on $50 billion worth of imports from China. And then end of the month, investment restrictions on China. So there's a lot of things, and I think the markets are starting to get concerned. It's upstream, industry, so it's going to affect a lot of products and retaliation. So I think a lot of Asian countries' trade can be affected. Our view is that China is going to significantly increase imports of US agriculture and energy products. We think that is going to happen. I mean, from China's perspective, in the second half of this year, we think domestic demand is going to start to soften, and they don't want a trade war at this point. The key thing is there can be unintended consequences. There's no real winners when you start to have restrictions.
Okay, there are no winners when you start putting restrictions, and the impact of that was also seen on Wall Street because the markets in US ended lower, reacting to President Trump's tariff announcements. The Dow dropped 250 points, with Boeing contributing the most to the losses on the index. The S&P 500 declined around 0.7%, while the Nasdaq pulled back 0.3% at close. Meanwhile, in economic news, the Commerce Department said that consumer spending jumped 0.6% last month, the biggest gain that we have seen in the last 5 months. Also, remember, non-farm payrolls data is due later today. The US is expected to have added around 178,000 new jobs in May, and unemployment rate is seen steady at 3.9%.
Okay, turning our attention then to the European markets. They closed lower this after the United States said it would impose steel as well as aluminium tariffs on the European Union. Europe banking stocks, they were some of the worst performers in trade yesterday. They were dragged down by Deutsche Bank. That stock was under some pressure. And just take a look at the three frontliners. You have the FTSE that was lower, even the CAC was lower, but the DAX, that ended with a cut of more than 1%. So let's get the DAX back up for you on the screen. That was clearly the big underperforming market in yesterday's trading session, ending with a cut of more than 1%. In terms of economic data, the Eurozone inflation rate jumped to around 1.9% in May. That compares with the reading of around 1.2% in the previous month. But let's move to the peripheral indices. The IBEX, that's the Spanish index, that was a relative underperformer yesterday. It ended with a cut of around 1%. The Italian index, remember, it's been moving sideways for the last couple of trading sessions. That ended more or less flattish. But if you're looking for green out there, then the Irish market did give you some green. But from the emerging markets then, the Brazilian index continues to bounce back. So that market was up close to 0.9% in yesterday's trading session. The Russian index, as flat as can be.
Okay, let's move on and talk about the currency space then. The euro is poised for its first weekly gain in 7 weeks on Friday as worries over Italy's political crisis ease. But the Canadian dollar as well as the Mexican peso were hit when Washington lifted exemptions from tariffs on imported steel and aluminium.
And turning our attention then to the world of commodities then, US crude oil prices stabilizes after deep losses in the previous session on pressure from all-time US high production as well as expectations of higher OPEC output. That's what spooked them. Remember, US crude production has been rising to record high levels since late last year. This morning though, Brent crude prices still holding at around $77.5 per barrel. Now back home on Dalal Street, the market surged in the final hour of trade. Classical expiry playing out yesterday. The Nifty rallied more than 1%, reclaimed the 10,700 odd mark. The Sensex too jumped nearly around 400 points. And in fact, we had star performers yesterday, the Nifty Bank. That was a clear star yesterday. A relative underperformance though coming in from the mid-cap index when you see such big gains on the frontline index. But Anisha, today we're kick-starting a new series, the June series. What a series it's been, May. You know, everyone talks about sell in May and go away. That just hasn't happened in the last 3 or 4 years at least. Every time in May, you wait for sell in May, go away. Either 100 or 200 points is what you get on the Nifty. This time around, how are Qs stacked up for today?
Well, yes, I'll come to that, but just a recap of the May series that you're talking about. The Sensex gained around 1.7%. Nifty also added around 1.1% in this series. The star performer of this series was clearly Bank Nifty. Now, that one gained over 7.5% this series. So, clearly, sell in May and go away theory not working out for that. But the mid-cap index was under a bit of pressure because that lost around 5.5%. Now, talking about yesterday, all of that gain that we saw in series was actually added yesterday, especially towards the last hour of trade. The Nifty managed to close above that 10,700 mark, and the major support actually came in from HDFC Bank, partly because what Nimesh has been telling us about the SEBI restrictions and how FII will not be able to buy that. So HDFC Bank gained around 4.5% in trade yesterday. It contributed 65 points to the Nifty Bank. Mid caps were, yes, under a bit of pressure. probably because there is some margin requirement that is expected to go up as well, so that added a bit of pressure. But talking about the fund flows, the volumes were really heavy, both in the F&O as well as the cash volumes yesterday. But net figure, if you look at it, the FI has just sold around 15 crores. The DI has also sold around 270 crores. So not major cues coming as far as the fund flows are concerned. But talking about the cues for today, well, a lot of global action actually happened overnight. We had the anti-establishment parties in Italy reaching an agreement to form a coalition government. But Nigel, before we could have reacted to that, we have some negative cues coming from US, wherein they have announced the tariffs on steel and aluminium from their allies. The result is that the US indices were down. Dow was down about 250 points. The impact was seen even on the equity as well as currency of the other countries like Mexico, Euro, etc. On the other hand, crude is steady at around that $77.50 mark. In terms of domestic cues, the GDP data came in better than expected. We were working with a strong number, but still we got it better than expectation, a 7-quarter high. Other than that, auto sales numbers today, so that should really play out for the markets. Important levels to watch out for. The 20-day moving average for Nifty is 10,660, so that is something to watch out on the downside. On the upside, 10,780 is what the traders say might be a stiff resistance.
Absolutely, Anisha. Those technical levels, keep an eye out on that. But Anisha, some stocks that we should be looking at today?
Well, yes, HDFC Bank, as I mentioned yesterday, was in focus. Let's see whether it continues the up move today or not. Auto stocks as well. April sales numbers will come out today. Expected to be a good month for that. Axis Bank, L&T and ITC will be in focus because exclusive sources tell CNBC TV18 that Niti Aayog has strongly pitched for selling the Suti stake. So let's see how those react. ONGC, a positive thing because it says that no communication has been received from the government about sharing oil price burden. So that should remove the overhang a bit. Another exclusive coming our way, wherein we understand JK Paper has submitted a resolution plan for revival of Sirpur paper mills. So that should go down well. Idea Cellular, wherein they have completed the sale of standalone tower business to ATC Telecom Infra. Other than that, a lot of these packages were won for the Mumbai-Nagpur Expressway. A lot of them came during market hours, but a few names also came post-market hours. So that will be in focus. Other than that, Reliance Infrastructure would be in focus because they are holding a board meet to discuss a private placement of NCD, so that will be in focus. M&M because they have signed an MOU with Government of Maharashtra for electric vehicle manufacturing. Sudarshan Chemicals because they have a board meet to discuss selling stake in one of the subsidiaries. Atlanta, that one was down 20% yesterday, but yesterday they came out with some clarification. Let's see whether the investors take notice of that or not. Budal Chemical, the company is looking to increase stake in TCPL to 59% now versus 42% that they have. And lastly on PNB because they have changed the MCLR from June 1st and the base rate is now revised to 9.25 versus 9.15. So let's see if that one reacts as well to that.
Splendid. Thanks so much, Anisha, for giving us entire trade setup as well as all the stocks we should be looking out for. But time for a short break then. On that note, up next, well, let's get straight to the big macro cue for today. The GDP growth for the fourth quarter came in at around 7.7%. That is a 7-quarter high, in fact. And for the full year, growth came in at around 6.7%. This, however, is the lowest annual growth rate in the Modi regime. Lata Venkatesh joins us to give us all those details. Lata.
The numbers are out there, 6.5% GVA and 6.7%, lowest in the Modi era. But remember, this was plagued by demonetization and GST woes. But the important point is that although we are impressed by the fourth quarter number of 7.7%, large part of the heavy lifting has been done by the government. And why do I say that? Because if you looked at GDP from the expenditure side, private final consumption expenditure grew by just 6.6%, lower than the previous quarter of 7.3%. So private final expenditure, though we say the rural economy was spending a lot and cars are being sold, private expenditure has not come good. Secondly, government final consumption expenditure rose by a massive 16.9%. That's really firing. And thirdly, and this is a very good number, gross fixed capital formation. I gave you expenditure numbers. These are saving numbers and investment numbers. Gross fixed capital formation rose at 7.6%. Not a bad number at all. And if you see for the fourth quarter itself, it's a massive 14.4%. Is that very good? Again, economists tell us that a large part of that 14.4% was government expenditure, state government and central government, private consumption, private investment didn't come good. The second key takeaway from the numbers is that exports did not fire. For the full year, it grew by a mere 5.6%. And for the fourth quarter, look at that, just 3.6%. This at a time when global growth is actually firing very well. So that again would be a disappointment, probably accounted for by our supply chains getting disrupted because of GST. And a third takeaway, therefore, what do we have for FY19? From 6.7% in the year that ended, for which we have numbers, for the current year FY19, most economists are expecting a lot of headwinds. You know, we did 6.7% when we had crude, you know, between $35 and $60 for a better part of the year. Now we are at $70 to $80 a year. So that's one headwind for the current year. Higher interest rates. Most people expect 1 or maybe 2 rate hikes from the Reserve Bank, and already the bond market is showing very high yields. Given these headwinds, that 6.7% can become 7.1% or 7.2%, economists say. And even this will be first half heavy. In the current quarter and next quarter, we should see an even 8% number. That's because the base is very poor. First quarter last year disrupted by GST. But the second half will be probably 6 point something, less than 7%. Now, that's the quarter which will be preceding the electioneering, the election canvassing. May not work very well for the ruling party.
I don't think we are revising our estimates or the forecast for the current year, 2018-19, which was indicated at about 7.5%. There is no one-to-one relation between the oil price growth and the GDP growth. There have been various quarters and years when the oil prices had gone up, but there has been good growth also. So we at this moment feel that we should retain, and this momentum which you see from the quarter fourth number should see us through to this kind of level of growth next year.
Okay, on that note, let's also hear out what Rob Subbaraman of Nomura had to say on India's GDP growth and RBI's rate trajectory going ahead.
We think they're on the right path. So, you know, 7.7% GDP growth is pretty decent growth. And our leading indicators are suggesting it's going to remain pretty strong this quarter as well. There are some challenges, I think, emerging. So one is with this strong growth and with oil prices going up, so India's a big energy importer, inflation has picked up. So core inflation is running at around 6%. And the other thing that's happened is the current account deficit has started widening. Our sense is we are going to start to see India raising rates. We're forecasting the Reserve Bank of India to hike rates in August and October.
And not just GDP growth, India also recorded a 4.7% growth for 8 core sector industries. This growth was held by a healthy performance seen in coal, natural gas, as well as cement output, which increased on a month-on-month basis, although crude output declined by around 0.8% for the month of April.
Okay, on that note, let's slip into a quick break. Up next, Niti Aayog takes stock of disinvestment and strategic stake sale programs. Details on the other side.